got a new model with a huge amount of capital, and the model doesn't work. You combine that with the fact that the amount of capital in the family office space today is roughly $10 trillion. So to kind of level set that, there's currently $6.5 trillion in hedge funds worldwide, globally, and there's $10 trillion in the family office market. We are about to experience the largest transfer of wealth in history. So
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. And guys, we have a very special guest on today. He is an investor and entrepreneur and the founder and chairman of Diamond Wealth. He represents over 100 family offices, ranging in size from $250 million to $30 billion. Diamond Wealth invests in private markets, private equity, venture capital, real estate, and so many others. He's a division that focuses on philanthropy, wealth transfer, investment banking, social impact, and governance. And we're going to be impacting a lot of the family structure to be able to outperform at a higher level. And we're very excited about talking a little bit much about this. Now, he's also the advisory board of 10 privately held companies and acts as a chairman for 4 of them. He's also the chair of 2 Tiger 21 chapters in Chicago and chairs a newly created family office group for Tiger 21. Earlier in his career, this man founded Pinnacle Capital, a $250 million hedge fund that outperformed the S&P index 10 out of 10 years. Please welcome my next guest, the one and only Ron Diamond. How are you doing today, Ron?
I'm terrific. Great to be here.
Man, I'm excited about diving into this conversation because one of the things that I found so interesting is you coming from the hedge fund world to then obviously building the incredible business you have now, Diamond Wealth. Ron, you mentioned previously in one of your interviews how you saw some of the people around you cry and weep because of a certain situation happen and how that affected you. Ron, I'd love for you to just share that story with our audience now.
So in 1987, I graduated from Northwestern, and my first job was at Drexel Burnham. And Drexel Burnham at the time was the most profitable firm on Wall Street by a lot. It was like Goldman Sachs on steroids. And I remember 2 years into the job, I'm in a room. Fred Joseph, the CEO, calls an emergency meeting. I was a trainee. There were 10 kids in my class. And I remember him saying to everybody that Drexel is going bankrupt. And it was a surreal moment for me. It was, I can tell you I remember sounds. I remember scents. I could remember people's, every aspect of it. And in the 80s, typically men didn't openly cry on Wall Street. And literally, I'm watching most of the people in the room literally openly weep. And it was, like I said, it was a surreal moment. Many of them had lost most, if not all of their money, because they had all their money in Drexel stock. So from that, my takeaway was that I would always be loyal to people, which I always was and always will be. But I would not be loyal to a company. Because if Drexel could do this, anybody could do this. So based on that, my initial plan was to hopefully do well, run one of the divisions of Drexel, and be there for 40 to 50 years. That was my plan. But it didn't happen. And then they imploded, so I moved back to Chicago and I started a hedge fund. So that's how I got into the space initially.
So in the hedge fund space, was that an accidental thing, or was that something that you kind of you pivoted to because it was a natural evolution to the next thing that you should do as an investment banker?
Well, I wasn't really an investment banker because, again, in the program at Drexel, I kind of learned a little bit about a lot. So I was kind of training and learning a lot about Wall Street. And I didn't have a plan to open a hedge fund. I mean, my plan was to be at Drexel. But then when I looked at it, and remember in the 1990, it was actually very early in the hedge fund space. So I did a lot of research, probably did about 6 months worth of research and diligence to figure out what I wanted to do. And, I was a little bit soured on working for a company, so I wanted to start my own company. And then I started a hedge fund. So I started with a very small dollar amount from friends and family, that people, who'd known me for quite some time. And then we just grew it from there. But that's how we got started.
Because you obviously outpaced the S&P 500 10 out of 10 years while you were running that. And what do you think you did during those years that helped you outperform the S&P?
The number one thing was luck. Um, never. I think with all entrepreneurs, there's an element of luck to what they've done. Period. Timing. If I'd run my fund in the from 2000 to 2010, I would have not done nearly as well. So the 90s was a period where, if you're a pretty good stock picker, most stocks went up. So I'd say the number one thing was luck. Two, we did have good models. We were good stock pickers in an up market, and it was an up market, so we did well with that, and we were fairly disciplined. So that's really it. I mean, I'd love to say it was a brilliant strategy or these algorithms that I'd created. I'm not saying it was all luck because there's certainly some skill to it, but a lot of it was luck. A lot of it was timing, and I think that's true with a lot of entrepreneurs is being at the right place at the right time.
So I appreciate your authenticity. It wasn't some sort of, sexy strategy. It was very just, the right time at the right place and kind of, you got tailwind and kind of jumping on that bandwagon. Obviously, let's not downplay you guys' team and expertise and experience in that regard. So I want to just reiterate, obviously you guys were able to produce incredible results because obviously your head knowledge as well. Now, what was one of the reasons why you decided to have an exit after that? And then what was that next evolution or next vehicle you wanted to jump in?
Well, remember in 1990, it was very early in the hedge fund space. So people didn't understand what hedge funds were, and they thought you can make money in an up market or a down market. That's hence the term hedge fund. And you couldn't. You're good at one or good at the other. We were good at in an up market. We had a 10-year run. I grew the fund. We grew it up to about 250 million, so we done quite well. And then in the year 2000, I felt the market was overvalued. Now, I was wrong. It kept going up, and then ultimately it did go down. But if you're gonna head into a down market, we wouldn't do well. I wouldn't do well for my investors, which is the most important thing, and I certainly wouldn't do well for myself in a down market. So I sold the company to a market neutral fund, stayed on board 6 months, kept 100% of the assets on board, and then pivoted to my next thing. But it was the rationale was I felt the market was overvalued, and nobody's smarter than the market, and we had a very good run, and my clients would be better off, in my opinion, in a more market neutral fund than in a long bias fund.
That makes sense. So that was kind of the evolution of it. I want to talk a little bit about, because obviously at Diamond Wealth, you guys focus on facilitating incredible private marketplace transactions, and you've got a huge Rolodex and connection and relationships with a ton of family offices. But I want to start with the 30,000-foot view, what you are seeing, because you have a very interesting perspective and methodology in regards to family offices and really facilitating the right relationship and services. But what have you noticed in regards to the macro trajectory of where family offices and where they're infusing capital in today's world right now?
Well, let's take a step back a minute and talk a little bit about the evolution of family offices, because it's very, very few people understand family offices. Remember, there's roughly 17,000 family offices in the world, ballpark. 68% of family offices started since 2000, and half of those started since the crash of 08 and 09. So this is a very, very new industry. And you combine that with the fact that the industry actually, the model doesn't work, because only 25% of family offices make it to the second generation. 10 make it to the third, and 5 make it to the fourth. So you've got a new model with a huge amount of capital, and the model doesn't work. You combine that with the fact that the amount of capital in the family office space today is roughly $10 trillion. So to kind of level set that, there's currently $6.5 trillion in hedge funds worldwide, globally, and there's $10 trillion in the family office market. We are about to experience the largest transfer of wealth in history. So over the next 15 years, going to be $65 trillion that's going to be transferred from the baby boomers to the next gen in the next 15 years. It's going to be the largest transfer of wealth ever. So this market, this family office market, which is fragmented, siloed, and inefficient today, will be larger than the private equity and the venture capital markets combined. So this market is massive. And every bank, every law firm, every accounting firm, every service provider is trying to get into this market because that's where the money is. But it's a very hard market to crack into because a lot of it is, like I said, it's very siloed, very inefficient, and very fragmented. And a lot of the reason that a lot of these family offices were created was not so much that people had a huge desire to manage their own money. It was more the fact that they didn't trust Wall Street. Because remember, in 08 and 09, I used to run a hedge fund, and I had the ability to put up gates. So gates are basically the ability to say you can't take funds out. A lot of people didn't understand what was happening in Wall Street, and I think the impetus to start this and why it's grown so much really has to do with trust. So if you look at the evolution of this, you started with the wirehouses, which for 100 years, and technically they're not even fiduciaries, which is mind-boggling. 10 to 15 years ago, you saw a huge growth in RIAs, which are registered investment advisors. The reason for that had to do with alignment of interest because they were fiduciaries. It was a better model than the wirehouses. And then on top of that, you had the multifamily offices, which is simply a RIA that looks at things from a holistic standpoint. Rather than just creating alpha, they look at next gen, succession, governance, philanthropy, and all those sort of things. So this market is really, really new and growing exponentially. The other thing is with family offices, a lot of people will ask me, how much money do you need to have a family office? And there's no right answer. I would say bare bones minimum, you need 250 million, maybe even 500 million if you're going to invest in the private markets, which is what we do, private equity, venture capital, real estate credit. Less than that, again, it's a ton of money, and anybody who made money in anything, I make no judgment. They could do whatever they want with it, but they're better off going into a multifamily office than a single family office. So the amount of money you need, certainly in my opinion, to have it make economic sense to start a single family office is a minimum of $250 million. And there are many family offices that are less than that are acting as single family offices, but if you reverse engineer it, they'd be better off going to multifamily offices.
And that is mainly because of the cost associated with that, as well as the infrastructure that it's needed to basically the expense of it for a single family office. Versus it wouldn't.
Right. A single family office, a single family office, I'm paying for my own accountant, I'm paying for my own lawyer, I'm paying for my own admin, I'm paying for my own staff. A multifamily office, I'm sharing that with 20, 30, 40 other families. So that's divided.
Now, I want to loop back in regards to, because this is a very important part. We talked offline, and I've listened to some of your other podcasts and content out there, Ron, and you talk about how the private equity, specifically in the marketplace here, there is this conflict of interest. And I want you to just tear that apart for us. Help us understand what that means. What do you mean? What do you see? And how the private equity, how the model there is a conflict of interest, and enlighten our audience. I think this is a really, really good point that you share.
Well, let me start by saying the private equity industry is an incredibly successful and profitable industry. It's done extraordinarily well. It's well outperformed the public markets. So as an industry itself, it is a fabulous industry to be in. And I have money in private equity funds. I think what happened was in the early to mid 80s, private equity disrupted the public markets. And the reason it did is because if you're a publicly traded company and you've got to report to a guy like me or an analyst every 90 days, it's very hard to run your company. You're basically managing earnings, right? You're doing things. It's hard to take a long-term outlook. So the reason that private equity and venture capital disrupted the public markets was because it was actually a better model. Because if you think about it, they didn't have to report to somebody every 90 days. They could look at things not as myopic, and they could look at things much longer term. And they had the ability to make long-term investment decisions, not decisions based on how my quarterly earnings are going to look. And in the 80s, private equity and venture capital exploded. It was a better model. 2% covered your overhead. 20%, I only make money if you make money. That's called an alignment of interest. So that was a good model. What's happened in the industry, and again, I'm generalizing, but many, not all, but many of the private equity firms have bastardized the business. It's become an AUM game. And I'll give you a specific example, which happened to a close friend of mine. A good friend wanted to do a roll-up of logistics companies, and he had a tremendous track record, and he needed $150 million. He went to a placement agent, and the placement agent was able to get him $500 million. His track record was that good. He told the placement agent, terrific, he just needed 150 and they're ready to get started. The placement agent literally came to his apartment in New York and wrote down 2% of 500 million equals X, 2% of 150 million equals Y, what am I missing? And my friend, who was a bit incredulous, kind of scratched his head and said, well, what you're missing is if I do what you want me to do, there won't be a fund two, because I can't deploy $500 million efficiently. I could deploy $150 million. And yes, I'm smart enough to know that 2% to $500 million, I'd make more money today. But my clients wouldn't do as well because I couldn't deploy the other 350. To me, and again, I'm generalizing, but that's a microcosm of what's happened in the industry. These funds have become too big. And if you do look at it from an economic standpoint, if they're getting 2% every year as an annuity, irrespective of how they do, they're incented to get bigger and bigger and bigger. And then they basically have to invest in areas that they, A, might not be experts in, or they have so much capital and many times they have to overpay for it. So when I say it's a conflict of interest, I'm making a rash generalization that it is a conflict in general, but not with every private equity firm. But that's what you're seeing. And the model, if you talk to people in the private equity industry, I mean, they won't tell you on a podcast, but it has become an AUM game. And that's, the main thing I look for is alignment of interest, and interests are not aligned with the current model today.
So what do you suggest that family offices should kind of evolve to? I've seen a lot of going more direct, listings, direct investing, and collaborative in regards to family. What are you seeing, Ron, that if there is not alignment over in this industry, there's still opportunity, but there's just misalignment in regards to the structure of it? What are you seeing that would be a good solution to it?
Well, remember, I think we're in the second inning, maybe third. We're still very early in the evolution of family offices. So family offices in general, they cannot compete with the Carlyles or the Blackstones or the KKRs, the big private equity shops. So in many instances, it still is your best model to invest in these large private equity funds, even though I think I could argue you could do better. Now, let's look at one end of the spectrum. If you've got 17,000 family offices, most of them are fragmented, inefficient, and siloed. But let's look at Paul Carbone's a good friend. He runs PPC, Pritzker Private Capital, for the Pritzker family. They've institutionalized it. Okay, they can compete directly with Carlyle and Blackstone, but they've got a team of 45 people. The biggest advantage that they have, and it's not just the Pritzkers, Michael Dell's got a family office that does this. There's several family offices that can do this. They have something called patient capital. So the model for private equity today is they're incented to flip companies every 3 to 5 years. So if you think about it, if they're incented to flip companies every 3 to 5 years, what happens is private equity firm in many instances sells to private equity firm B, and they sell to private equity firm C. And everybody makes money until somebody doesn't. So over the course of 20 years, you might have that the same company change hands 3, 4, sometimes 5 times. If you look at the taxes and if you look at the transaction costs that were paid during each of those changes versus a family office who has patient capital, who's looking to compound it and who's looking to buy it and hold it, and they bought it in year one and they're holding it for 20 years, the results by compounding it are exponentially greater. So it is a better model. Having said that, the industry is not quite ready to do that because most family offices are not nearly as sophisticated as the Pritzkers or the Dells or some of these other family offices. So what has to happen is you have to see the industry evolve. Now, it will happen because by definition, anytime there's something that's a better alignment of interest, in general, that's going to play out, but it's going to take years to do this. One of the things family offices have to do, it has to do with compensation. So right now, and I say we're only in the second or third inning of the family offices, in general, if a family office is going to pay somebody out of Stanford or Harvard, $250,000 or $500,000 a year, many of them look at that as a cost. In other words, that costs me $250,000 or $500,000 to hire this person. If Carlyle or Blackstone hires somebody and pays them $250,000 or $500,000, they don't look at that as a cost. They look at that as a potential $20 million profit center. So again, it's nuanced how they look at it, but until family offices start looking at it through that lens, they're not quite ready to do it. Also, you touched on something earlier, which was interesting, and we do a lot of direct investments. The problem is that post-crash, pre-COVID, for 10 years, everything went up. Private equity, venture capital, real estate, credit, Bitcoin, no matter what you invested in, pretty much the assets went up. So a lot of these family offices, they did direct deals, but the rationale was, I don't want to pay $220, and that's not the reason to do it. You don't go to a doctor because he's cheaper. You go to a doctor because he's the best. And so what happened is a lot of these people got ahead of their skis, and I think that because why would they pay $220 if they could pay zero and make money themselves? We're in a different time now. Money was free back then. The Fed was printing money. Now you're at a period where I believe I believe it's going to be a bit steeper of a recession than people believe, but it's harder and harder to make money. And as these direct investments don't work, I think what's going to happen is you're going to see a backlash, and a lot of these family offices that did the direct deals are going to realize there is a skill set to doing this, and as a result of that, they're going to go back to the private equity firms. So what I'm talking about is going to happen not overnight, not over a year, not over 2 years. Over the next 3 to 5 years, you're going to start to see it happen. Over the next 10 years, I think you'll see a big trend. And you're starting to see some of the universities get into this and have people educated about it, because at the end of the day, patient capital is a better model. And the problem right now is that in the family office world, the issue is oftentimes they like to be secretive, which is their prerogative, but people don't know what they're looking for. So if the smart people can't find the rich people and the rich people can't find the smart people, how do you connect, right? So that's a problem. That's starting to be solved for, but we're still very early. But the fascinating thing about the industry to me, and why I love it, is this is happening in real time. Real-time change right now. So you're watching family offices slowly become less siloed and network more, slowly become more efficient, slowly become more institutionalized, slowly network more and more, and you're watching an industry which I would argue is almost in its infancy,
right? You don't
start
go
to mature, and
it's
that's
expensive.
exciting.
You go to because they're the best, right? And I think that's a really good analogy about what's going on, of course, and I appreciate you bringing that up in regards to, hey, you can do direct investing, or you can come over here, the private equity. They already know, they already have the system, they already have the infrastructure, and yeah, you have to pay a little penny, but also at the end of the day, your probability of succeeding is much better than doing it yourself sometimes, right? The probability could be a 50-50 win with a private equity. So a really, really good analogy on that. And then also in regards to fragmented, you mentioned this in other interviews as well, and there's an inefficiencies in regards to, maybe networking groups, events, things like that. I'm noticing a lot of family offices. Each one, they all have their own different thesis. And I've talked to numerous ones, and I know you have numerous people you've talked to. And each one has their own different thesis, their own strategies, their own underwriting processes, all that stuff, right? And Ron, I'm curious, when you work with these family offices, is there a methodology, or is there a principle, or is there a way to you help them navigate this uncertainty in regards to that preservation of wealth?
Well, first of all, I think that with family offices in general, I just think most of them are not qualified. They're not capable today to do direct deals. They don't have the infrastructure to do it. And then you also think about, who are these family offices? These aren't necessarily titans of Wall Street like George Soros or David Rubenstein, who created one. These are the guys who created Beanie Babies or 5 Hour Energy or a chain of gas stations. And it's a different skill set to do that, which is terrific, than it is to take $1 billion and grow it to $2 billion, do some estate planning, wealth transfer, philanthropy, and grow the asset base. So you've got huge amounts of capital in general, inefficient hands. All we do, what I do, is I like to invest in the private markets, which is private equity, venture capital, real estate credit, and I'll put in a small dollar amount. We work with about 100 different family offices. These are families ranging anywhere between $250 million to $30 billion. They'll put in the bulk of the money, and we don't charge anything, but I'm not doing it for self-list purposes. I do it selfishly, because if I'm just putting in $1 or $2 million, I'm the lowest guy on the cap table. But if I could put in $50 million or $100 million per deal, which I can't afford to do, but cumulatively I can, I'm going to get really good access. So I call it first call alpha. So what I do is act as a funnel in these deals, and then I surround myself with people that are smarter than me in each different area. So if it's a private equity deal, if it's a real estate deal, if it's a venture capital deal, I've got people who that's what they've done for a living, and I help them vet. The other thing we're able to do is, a lot of times we're able to work with these large family offices that have already vetted the deal. They love it. It's just too small for them. So a $20 million deal might be too small
so you're
for
really a resource
one of these
pool,
large
right?
family
so
offices.
You not only are
it's
able
not
to
too
help
small
these
for me.
family
So
offices
that's another
their
way that we're able to get good deals
together to deploy, but also their resources, their knowledge, their expertise, everybody's skill set to be able to acquire and be able to leverage in the private markets. And a very, very interesting concept. Now, let me ask you this in regards to, we're seeing right now, like you mentioned, there is a recession kind of going on a little bit, and that may or may not kind of pivot a little bit further downward. My question is I'm noticing, and the family office I've talked to, they're kind of sitting on dry powder, waiting for the uncertainty to clear up, and then they're going to infuse and deploy capital. And I'm curious, Ron, what are you noticing? You've got very well-established connections. You've had, you mentioned Carlisle. You had Dave Rubenstein on your podcast, which is really awesome recently. So what are you noticing, getting a heartbeat on where people are at right now, investors, on an active basis? Are they kind of sitting on dry powder, you noticing? Or are they still deploying capital, but just the right deals? Or what are you noticing?
It's a really good question. I will tell you a story. So my father was a banker. He was a brilliant guy. And he used to tell me, and when I'm in college, you don't fully understand it because you're in college, right? But he used to tell me you could always see who the lawyers are in the room and who the entrepreneurs are. And he said, in general, the lawyers would come into a board meeting, and try to show or be the smartest guy in the room, right? That's what, and again, I'm generalizing. Entrepreneurs would come in and try to find the smartest guy in the room. Sometimes they were loud, sometimes they didn't talk at all. But their goal was not ego-based, where they basically wanted to show everybody how smart they were. They're just trying to find people smarter than them. All that I've done is I've just surrounded myself with people that are smarter than me in various areas. And so I consider myself an entrepreneur in that aspect. I'm not a full entrepreneur because I don't have the risk tolerance to lose everything overnight. And these entrepreneurs who I have a tremendous amount of respect for, you need a certain gut level, the ability to handle stress like that. I consider myself more of a wantrepreneur. I'd love to be an entrepreneur, but I don't have the risk tolerance for it. So I'm kind of in between there. And I see a lot of entrepreneurs who are working for corporations and they're miserable. And conversely, I see a lot of people who aren't entrepreneurs. It's not that they're not smart, it's just they're not wired with the stomach of the ups and downs, and they should be better off in a corporate world. So I think people have to realize and find out kind of who they are, what they are. I think in the family offices in general right now, you're seeing a lot of people sitting on dry powder. And the reason they are is basically because they can. It's not complicated. Private equity firms can't. Here's why. they're compensated, remember, to flip companies every 3 to 5 years. So if that's how their compensation structure is, they can't hold a company or non-invest for 15, 20 years. Family offices can. So we saw a lot of instances over the last 10 years where family offices loved a business, loved an industry, loved a company, ready to buy it, and then a private equity firm would pay 2x or 3x times. We'd just be like, take it, it's yours, right? It's worth a lot, it's not worth that much. So that's another problem with, in my opinion, with many of the private equity firms. They're sitting on a lot of dry powder, but at some point in the near term, they're going to have to deploy it. Family offices don't have the time constraint, so the IRR, internal rate of return, is a moot point for family offices. So it's a fascinating dynamic to watch, and we saw many companies, the private equity firms, just way overpay for companies, and they're going to be hit down the road.
In the structure
But
of the ordinance.
family offices
You
can be
mentioned
patient, and they
something
are.
which I
They've
found
got
very
a lot of
interesting.
dry
I just
powder
got
right
off
now.
a phone call the other day with a fourth generation family office, and I was like asking him because I know we were going to be talking about this, and you mentioned, of course, 10% go to the second, third generation, so it like exponentially decreases the shelf life basically of the generations of a family office. And I find this very interesting because, Ron, like you just mentioned, and I'm glad you brought this up, a lot of people aren't coming from Wall Street. A lot of them, they made their money in real estate. They made their money in manufacturing. They made their money in Beanie Babies. I love that. I love that story. And they don't know how to deploy that capital. And that capital, like you mentioned, is not being deployed effectively with someone that knows how to do it and how to take $1 billion to take it to $2 billion, or take, $250 million and drive it to, $1 billion. My point is you work with so many, and each family office is contextually different, and they have their own thesis, their own strategy, their own thing. But do you guys have like a methodology or the way you talk about it and help them find their ethos, find their investments, find the way they structure it? What is their risk tolerance in regards to, hey, how are you going to deploy the capital in what industries? Because there are tons of opportunities, even in the private equity, even in the VC. There's tons of different funds. Everybody's raising capital, and these family offices are getting knocked on all the time. Their doors getting knocked on all the time in regards to more and more money. So my question is, how do you help someone that's not very familiar with this industry to have a lot of wealth, they know how to make money, and then simplify their thesis so that they can grow and preserve their family, so that they, of course, can get it from second, third, and fourth generation?
Yeah, I mean, you raised a good. I mean, the statistics are 25% make it to G2, 10 to G3, and 5 to G4. So the model itself doesn't work. My job, my role is not to have these family offices teach them how to make it to third, fourth, fifth generations, because again, they made their own money. They could do whatever they want. And I've often said, and I've gotten pushback on this, but I believe it's true. The biggest obstacle many family offices have is actually the ego of the patriarch or matriarch, right? Because they did really well. They crushed it in one specific area. It doesn't mean it's transferable to another area. Because I did fairly well in running a hedge fund doesn't mean, I could be a profitable manufacturer of widgets, right? So I think that's a huge issue. All we do is I know like the families we work with who likes what. So if it's a multifamily real estate, there's 70 families that like that asset class. If it's cannabis, there might be 6. If it's healthcare, there might be 20. So I know who likes what. I'm not going to bring anybody that something they don't look for. And if they want to come in, terrific. And if they don't, that's fine too. It makes no difference to me. So I'm looking at it through the lens of a filter, and I'm looked at more as somebody who helps them vet direct deals. My job is not to help them with governance and succession and next gen and things like that. I can offer them advice. The very first thing, what happens when people have a liquidity event, the very first thing they want to do is they want to invest in a cool real estate deal or cannabis deal or private equity deal. And I tell all of them, before you do any of that, talk to an estate planning attorney, which is not fun. It's boring. but it's the foundation of a house. So unless you have the right foundation, it doesn't matter how well you invest. I used to run a hedge fund, and I remember when I started, there was one specific instance where it was $1 billion family, and I really wanted to get the business. And he had his family office trust and estate planning attorney in the meeting, and he didn't know what I was talking about strategically. And after the meeting, in a nice way, I asked the patriarch. I said, "Why was he here?" I mean, I asked nicely, obviously, and then he kind of put his arm around me and he said, "The goal is not to be worth $1 billion. The goal is to be worth zero, but control as much as you can." And that's what trust and estate planning attorneys do. They make you bulletproof from a litigation standpoint if they do a good job, and they transfer things out of your estate. So the goal, like I said, is not to be a billionaire. The goal is to be worth as little as possible, but control as much as possible.
This fragmented
so the first thing they should do is talk to an estate planning attorney. Do most of them do that? No.
But that's one of the reasons why you're obviously bringing this up and iterating this. I want to pivot a little bit toward the private markets. Ron, like you mentioned, your goal is to run point guard to basically find the deals and bring your whole ecosystem, Rolodex of individuals, and present these deals. And I know that is because of your deep relationships. They know, like, and trust you, right? And with that, there has to be a lot of hurdles that those deals have to be filtered through before you actually present them to the table and say, "Hey, family office XYZ, would you want to invest? Let's collaborate on this." I know each vertical is tremendously different, from private equity to VC to different real estate, whatever it is. How do you approach it? And I know that's kind of a big question, but I want to ask, how does Diamond Wealth approach underwriting, looking at it, filtering it? Do you mainly focus on a specific industry, or do you mainly focus on specific EBITDA margins and so forth? I'd love to get your perspective on, and I know each vertical would probably have its own thesis, but I'd love for you to just unpack that for our audience.
Sure. No, it's a really good question. And again, I'll go back to, I surround myself with people that I trust implicitly, that are smarter than me in various areas. So I don't invest in the public markets, even though that's where I made most of my money when I ran my hedge fund. It was very easy, or not very easy. It was easier to create alpha in the public markets in the 90s.
I mean,
I think today I just have money in index funds, and I would argue with people in the public markets. I do think you can create alpha in the private markets, which is private equity, venture capital, real estate credit, and that's why I gravitate only to those areas. And then in each of those verticals, I've got people who are best in class in real estate, best in class in private equity. I chaired the Disruptive Technology Center at Stanford University, so my term just ended, but I did have access to a lot of really smart people if it's a venture capital deal. So I'm able to get help from that. And then you combine that with the fact that many of the deals we get come from the family offices that they might have a team of 25, 30 people that have vetted the deal to start, and they love the deal. It's just too small for them to do. So there's an extra layer of vetting. So that's basically what we do. That's how we do it. Hey, it dropped again.
Oh
no. We don't have to start over, but can you do the TV with me? I'm sorry.
Yeah, one sec. How's he gonna edit that?
I have no idea. I'm not starting over.
Do you think it's worth just switching to Zoom?
Well, let's just go back to this first.
Password?
9 yellow jello 1 Paul 666. didn't end. I just got cut off, so it might not have ended. I think he's still there, but I can't hear him. He can't see me.
His signal's dead.
Hey, Christian?
Ron, you there?
Yeah, so I think that it's on your end. It's not on my end.
Yeah, can you hear me?
All right, can you?
Yeah, it just kicked me out again. I apologize. I'm not sure, but let's start over with that question.
Okay, thanks, Cody.
Yeah, let's just start over with that one question.
All right,
and then I can edit it.
You don't think this will happen again?
No,
you'll edit
I don't
it.
think so. We'll be able to just finish this off a little bit and then a few more questions. Okay, so yeah, my team will edit it. All right. So Ron, let me ask you this. Let me do this. Team, you got to edit this last bit here, and then we'll go ahead and adjust this. Ron, so one of the things that I found very interesting about this is, you have obviously worked with your family office Rolodex quite a bit, and have you ever gotten a company, underwritten, went through all the hurdles, went through all the little things, and you got it down almost to the 5-yard line, and you're almost over to the finish line, right? And where all of a sudden there was a red flag, maybe a few red flags, and you're like, you know what, let's pull away from this deal. And what was that? Have you ever been in that experience? And what were those red flags that prevented you?
The answer is yes, and that happens a lot. We'll probably vet
with whatever
close
deal
to 100 deals before we pull the trigger on one. So there's a lot of deals that are very attractive and good, but due diligence it takes a lot of effort and a lot of thought in looking at different things and talking to different customers, talking to different people in the industry. So yeah, there's many instances where we're very close, but it doesn't check every box. We just don't do it. And the beauty is we don't have to.
So with that due diligence process, what boundaries or systems have you learned from other deals that allow you to keep consistent with your pattern of finding the right deals? Like you mentioned, you vet 100, but only a few you actually deploy capital with. I'm curious, what are those boundaries or systems you're noticing, like the big red flags that off the bat you're not going to
look at the question from the other side. I look at it from the question of what types of companies do we typically invest in, and I would say the common denominator is relationships. Relationships are the most important thing when you're working with anybody in any business. I don't care what you do. We've developed a network of really, really good relationships. I've spent 25 years doing that. And so if they come to me, I know initially I trust them implicitly, so I can check box A through Z on that part, and then I diligence the other parts of the deal. But if it's people you know and you trust, which is how people we work with, it's a lot easier to diligence a deal because you know that their goal is to make money for you. Their goal is to make money for everybody. Their goal is not to just try to make as much money as they can off of you, right? So you can see through that. So we've been very thoughtful over the years of working with fewer and fewer companies. And when they have deals, we've done multiple deals with some of these people. So it's all based on relationship and trust.
Yeah, that's what I love about this industry specifically is, what I've noticed is it's just networking with the right people, having the right conversations, and a lot of those deals or a lot of those opportunities are always off market. You're never able to actually see them and all the other things, and so it's just by networking and talking to someone. I was talking to someone that owns a minority position in a franchise, in a sports franchise, and he was saying the only way I got an opportunity was by networking with someone, and they mentioned that. Ron, for those that want to reach out to you that are listening to this and they want to, learn a little bit more about what
Well,
you
I'm
got
fairly
going on,
accessible
how
by
they can maybe
LinkedIn.
collaborate with
I don't
you.
use
How
social
do they
media
reach
other
out to
than
you, my man?
LinkedIn, which I'm actually very active on LinkedIn. So that's probably the easiest way. And then I do have a family office podcast. It's called FamilyOfficeWorldPodcast.com. That's another way they can get hold of me.
Awesome. And guys, those links are in the description below, so make sure you stop what you're doing and make sure you consume that content. In fact, he's actually interviewed some incredible people on his podcast recently, Family Office World Podcast. I'll put all those links down there in his website as well. And Ron, I really appreciate you being on here and unpacking your journey and your story and the things that you've learned, but also the things that you see in the fragmented kind of industry right now, but there's also opportunities, but you have to navigate it and have to work with people like yourself that know how to navigate it and harness resourcefully everybody's skills and abilities. Ron, I really appreciate you being on here. I want to ask you before I let you go fully, you've obviously done very well for yourself, and you're striving for success and the next level and constantly driving for that. But if you could think about that young Ron, 1990, 1980, just starting out, okay? What insecurities did you have to overcome to become the Ron that you are?
When you're just starting out, you don't know. You try to surround yourself with smart people, and I did fairly well in school. But look, at the end of the day, a lot of it's going to be, if you do well, you're going to get a little more confidence. I think that a lot of people have insecurities when they start out. What I've been pretty thoughtful about is surrounding myself with people who are older than me, because just because they're older doesn't mean they're smarter, but in many instances they're wiser, and I learn a lot from that. So by listening to people who've been through it before has been very helpful for me.
Very well said. Very well said. And I can always tell you're a humble spirit as well. You're always talking about how you're being mentored and facilitating the right environment around you. Guys, that is my friend, the CEO and founder of Diamond Wealth, the one and only Ron Diamond. Guys, that is Journey with Christian Diamond's podcast. Until next time, be uncommon if you can.